Please welcome Ms. Binni Ong.
Today, I want to focus a little bit on money, which is Forex. Okay, and also a little bit about intermarket analysis, something for you to take away. Now, before I start the presentation, we saw that there was a huge rise last year, somewhere October, November. Any of you gotten in during that huge surge? That means to pick the bottom. All right, now my session is to talk about why there was a huge surge then. Next is to give you something to take away so that you can track that on your own. So that's the purpose today. All right, before that, disclaimer as usual. Today is, just my opinion, educational. If you do have questions for myself and Jamie, you can go to Pigeonhole, where the passcode would be STF2023. Right, agenda for today. I know that you heard a lot about Fed fund rate, and also recession. But I wanted to point to you this indication which you can monitor if there should be a turn, not opinion, but indication. That means that things that you can use to track. Then people ask, what would be an earlier indication to know that whether we have a recession or whether, apart from looking at the fundamental of the companies or the technical analysis, would there be any other things that can give us like an earlier warning? So that's the purpose of the second part, which is to talk about the money markets. And lastly, how you can, in this current market condition, maximize. And that will be covered by myself and by Jamie, because we talk about how to bring value to you during this session. Therefore, one of the objectives is really to look at the current market condition and how you can maximize your returns. All right, a little bit about myself. This is me. In SGX Academy, I am the SGX Academy trainer. But if you have heard me elsewhere, then I'm mostly invited to speak, especially to the institutional players or traders or investors on Forex, which is money market. That means that known to SGX Academy, the crowd, the stock market, but unknown to a lot, I'm actually one of the key speakers in Forex. Today, I'd like to talk about how you can connect or apply the stocks with inputs from the money market as well as interest rates, which is what we call the intermarkets. The other thing is I'm doing a lot is on system analysis. That's why we look at multiple instruments to help us into investing and system. And in fact, that today's topic was something that I presented widely last year in October and November to the institutional investors. That means that last year, while we look at the intermarkets, I presented this topic to them, and it was in fact very fruitful. So today I hope that I'm not too late to present this again with new inputs, especially to what's happening right now with, for example, SVB. That's our concern. And the question is, what's going forward, whether there's any rate pause, in fact, followed by rate cut. All right, so let's take a look into this thing here, which is the U-curve inversion. Right, what is U? U is the return from a bond investment. It's the same thing, for example, if you are putting money inside the fixed deposit, you get your interest. Okay, that's your U. By right, if you put, let's say, an FD, fixed deposit of a longer period, you have higher interest, right? For example, if you put a 2-year versus a 1 month, you get more interest, a higher rate if you put in 2 years, correct? Okay. Then why is it that the U is inverted right now? Because if you take a look at this one here, this one is not, okay, never mind. If you take a look at the left side of the chart, so this is how the U should perform. That means that when you buy a shorter term yield, it should have lesser interest versus if you buy a longer term dated bond. Okay, the yield for the longer dated bond should be higher. Same thing as the fixed D. But if you take a look at the yield right now, the shorter term yield is giving more interest. Okay, the shorter term bond is giving more interest versus the longer term bond. So that's called yield inversion. Right. Now the key question is then, why does the yield curve invert? Because if you take a look at yield versus price, it's like a seesaw relationship. Now, if the yield is down, the price is up. Likewise, if the price of the bond is down, the yield of the bond is go up. Now, right now, we are seeing the yield curve inversion because a few things. Number one, the Fed is doing a rate hike. So short-term yield is going up. But more important is that the long-term yield is falling faster than the short-term yield. The question is then, why is there a surge in demand for the long-term bonds? Because why is it that the long-term yield is falling faster? Right? That's because there is an increase in price of the long-term bond because of this inverse relationship. Therefore, if there is a surge for the long-term bond, then that will cause the long-term yield to fall. Then the question is, why is there a surge in the long-term bond that caused the long-term bond yield to fall? Anybody talk about this? Why is there a surge in the long-term bond then? All right, the key reason is that because, all right, a lot of investors, especially I'm talking about the large investors, they are less willing to take risks right now. Therefore, they are buying into the long-term bond to lock into that so-called longer period of returns. Then the question is then, why are they not buying the shorter term bond? Why are they buying the longer term bond then? Anybody know the answer? I think it's there. Because they are afraid of economic recession. They are not too positive about what's happening next. Therefore, they prefer to lock in that yield right now. That means you want to be guaranteed of the yield 10 years later. Therefore, you buy now to lock in the higher yield. Okay? Now, what is a typical observation is that when you have an inverted yield curve, it's typically associated by recession in the near future. So that is a published theory by the Fed of Chicago. Now, what is more important is that I have correlated these two charts here. That means that the red line is the Fed fund effective rates. What is Fed fund effective rates? That's your the interest rate that is being seen by FOMC. Now, the bottom one, which is the blue color line, that would be the difference between the 10-year yield versus the 3-month yield. Okay, that means you take the difference. All right, at the green arrow that I mark in, through the 30 years period that I've presented here, at the green arrow is when the yield curve invert. All right, now we can see right now, that means at the current period, what would be the observation? Is that the yield curve had inverted. But what the history show us is that each time when the yield curve inverted, the interest rate peak. Okay? Now then, take a look at the gray color shaded area. That would be where is US recessions. That means after the yield curve invert, after the rate peak, that would be a period of US recession. Okay, so we're going to just cover here and take a look at the next slide. Okay, just give me a minute because, okay, never mind. Right now, what I did here is to highlight each of the crises. That means that each of the crises that happened during key point of where the interest rate of the Fed peak. All right. Now, take a look at this overlay where we have yield curve inversion at the green arrow and where we have a peak of the Fed rate, then we have that shaded area. Then what was the shaded area in terms of, that shaded area was recession. But what actually happened before the recession was that they were always followed by crisis. And that's the key thing here. That means that in between the yield curve inversion, in between the peak of the Fed rate, and then followed by a recession that usually happens about 1 to 2 years later, in between then, there was a crisis that happened. I'm not saying that always when there's a peak in the rate, I'm not saying that always when there is a yield curve inversion, there will always be a crisis. But what we've seen in the past 30 years was that history has shown us there was always a crisis that happened before that recession happened. All right, then presented here would be number one, that the yield had inverted. Number two, we are seeing signs that the rate might be peaking. And the question would be, there are talks that there might be a recession. The question would be, right, whether there might be a crisis. And that's really up to us to think about it. History can't predict the future, but history will be like a mirror. So that's the first question that I want to let you guys think about, okay? Now, second thing is let's talk about then the interest rate and the stock market. Because we saw that last year, 2 years ago, all right, market was and right now still is talking about interest rate. I want to bring out that if you had studied about the yield curve, you might have gotten that turning point last year between October and November. Right. Now let's take a look at this one here, between the relationship of stocks and bond. And this is something that we know about it. Right. Same thing between stocks and bond is like a seesaw relationship. Because stocks, right, essentially will give you more profit, but it's viewed as a higher risk instrument. Whereas for bonds, typically safer, but seen as one that give you lesser return versus stocks. And we also know the factor that you have investors, right, have a finite quantity of funds, unless that you have a different situation here. All right, unless they tell me your funds are infinite, then this relationship will not hold true. Okay, but what we know is that when the bond yield are lower, then investors would, in order to favor that potential profit, they will sell the low yield bond to buy into stocks. Now, however, when the bond yield is higher, then they can lead to a lower share price. Why? Then they will shift out that investment for stocks and shift it to a bond. If you take a look to the right-hand side, when I took data from the bond yield of 1 month and 30 year. So 1 month yield was about 4.5, 6 month yield was about 4.89. That was the data on the 14th of March. If you take this and you see that US Treasuries would be one of the safest assets in the world, with this high bond yield, then a lot of pension funds, a lot of big institutional investors would have preferred to invest their money in the bond yield instead of stocks. If you compare that, for example, some of the as REITs average, we are talking about 4 to 5%. If you take this comparison, then of course we know that money would prefer to shift into the bond. But then what happened last year during 31st October period and during the November period, right? What happened? There was a V-shaped turn of the indexes. Both HSI went up like 50%, STI up by 15%, the US turned. And what really happened at that point of time? There was a lot of news flow. But what we observed at that point of time was that the yield curve inverted. So let's talk about the yield curve then. All right, just now I talked about the 10-year versus 3-year. But if you take a look at the underlying portion, a 10-year versus a 3-year yield spread has historically been viewed as a precursor or predictor of a recessional period. That means that when we observe that the yield curve invert, the market take it as a hint that there might be a recession coming. Whether there's a recession coming, it doesn't really matter. What mattered was that yield curve inversion was seen by the intermarket players, especially the bond players, right? They see that probably a recession will be coming in the headline. We're talking about news headline. Whether it's here, it doesn't really matter. All right? Now, if you take a look at the time, the date of the yield curve inversion, that was on October 25th, when the yield curve switched from a positive number into a negative number. That's where the yield curve invert. But more important is that we are not going to just take a day of data. We observe that for a week at least to see stability in the yield curve inversion. And that pretty much coincides with the turning point of all the key stocks indexes. That means the point, the day, right, the yield curve inverted, we saw that V-shaped turn of the stock market. Now, what does it say? It says only one thing, that at that point of time, the stock market was so sensitive to the interest rate, which all of us knew. But what was not known is that what kind of indication are you going to track? Then today, you walk out and you say that I'm going to track the yield curve, the difference between either a 10-year and a 3 months or a 10-year and a 2-year bond. That means a long-term versus a short-term. That will be the key indicator here. All right. Now, another proof to show that why the market was so sensitive to rate was that early this March, Powell testified in Congress that there's a need for higher and faster rate hike. Before he tested under the CME Fed Watch tool, which the futures market use it as a tool to price in the probability of the rate hike, the CME Fed Watch tool on 7th of March, before he testified, was that about 60+% thought that there could be a 25 basis point hike. But after he testified, immediately the ratio switched, just one day. All right, the market thought that there's a 70% chance of a 50% basis point hike. And what happened when SVB news was out? You know what that percentage changed? From a 70%, 50% basis point hike, when SVB news was out, that 50% basis point rate hike became 0. Immediately, there was a switch. Therefore, this tool here became so important to let us know what the market is thinking about. All right. In fact, that before the March hike, the market was pricing in a 70+% of a 25% basis point hike. And as of yesterday, all right, if I don't remember wrongly, the market was pricing a low percentage of a rate hike in May. Okay, but do watch out for this Fed Watch tool to understand how interest rate behaves. Now, we saw that how the market reacted, which is on the 7th of March, when Powell testified that SPX, which is S&P 500, went down by about 3%. STI reacted sharply as well the next day. So that's how sensitive, right? Right now, the market is of interest rate. And if there's one thing that we need to take out from here is that if you are going to look at a stocks investment, then we should not only focus on fundamental analysis and technical analysis, we should also focus on one more analysis, which is intermarket analysis. That is to take a look into what's happening into the money markets as well as the interest rate market. All right. Then, if money is so important, maybe the next question would be to me is that, Binni, do you have a faster leading indicator versus interest rate? Is there anything out there that can give me, all right, an earlier clue on what's happening to the interest rate environment? and that would be the money market. Before I moved on to this key index here that we're always using, let me just ask one question. Before you go to, let's say, another country for travel, what will you usually do? Before you go for, let's say you are going to Japan, right? What will you usually do? Money changer. Yes, correct. I thought that you are going to answer like buy air ticket, buy hotel. Okay, apart from buying air ticket, booking a hotel, you will go to the money changer and change your Sing dollar into Japanese yen. All right? Because there are places that doesn't accept credit card. Therefore, during COVID, you don't see people queuing at the money changer. After when they open up, you see a lot of queue. The one thing that you can conclude is, many people going overseas. Then you go and ask the money changer, where are they going? The money changer will know the answer. Whoever who changed that currency the most will be where they are going, right? Okay. Therefore, what I'm trying to say is that money will lead that action, the actual action first. That means that before you buy a stock, let's say you want to buy US stocks, what do? You have to convert your money into US dollar to buy US stocks. Therefore, money will give us that leading instrument. Now, in 2021, the headlines was 2021 during September period. Yes. The headline, November period. The headline was, half of Fed members now see central bank hiking rates next year. That was a headline. But when we monitor into the money market, which is the US dollar index, then we start to see that actually the money market is giving us a clue that the Fed is going to hike rate. First, let's talk about what is US index then. US index, the other symbol that we're using is DXY or USDX. Okay, it is an index that measures the strength of the US dollar. When you are investing or trading in Singapore market, we have STI. Hong Kong, we have HSI. Then when you are doing currency, we have DXY, which is the US dollar index. All right, we use the other currencies like Euro, Japanese yen, sterling pound to measure as a basket the strength of the US dollar. If you take a look at the purchase of the bond, if you want to buy, let's say, US Treasuries bond, I'm talking about huge investment. That means I'm talking about institutional investors or pension fund. If you want to buy bonds, right, you have to change your money into US dollar. That's one way to look at that. Now, the second thing is, of course, if at that point of time, Fed is going to hike rate, then it makes sense to invest your money in the US dollar because then US dollar is going to give you the higher interest rate versus any other currencies. All right. Therefore, before Fed actually hike rate, the dollar index already bottomed out and went up ahead of the actual Fed hike rate hike. Okay. Now then, how does this correlate with the index then? And that's a very important observation because a lot of time we only look at the index, but if you can apply some correlation, you realize that it works pretty much well. Because in this relationship here, we saw that in a high interest rate environment, the relationship between the dollar index and SPX, which is that means S&P 500, the relationship is an inverse relationship. Means that if the dollar index is high, the S&P 500 will be low, inverse relationship. Likewise, if the S&P 500 is high, then we are likely to see a low in the dollar index. Okay, how to understand this then? Let's say, for example, I want to buy bonds. Then what do I do then? Okay, either I perceive that the dollar is cheap, the bond is attractive, and then I transfer the money to buy bonds. Then where do I get the money from? In a finite relationship where you have fixed amount, fixed quantity of money, then you will have to sell your stocks or any of the liquid assets to put the money inside the bonds. Okay, so one of the things that we always observe in terms of what's happening to the stock market is that you observe the US dollar. That means you look at the relationship of US dollar, and we realize that when the US dollar is peaking, that's where the stock market is likely to be at a low. Then coming into a broader analysis of what is happening right now. Let's take a look at the right-hand side where we have the US dollar on a broader horizon from 1990 data all the way until here. Now the thing is that recently, that means last year in October, November, we saw a peak or near to a peak historically to the dollar index. And what does it suggest? Again, all right, that means that it wasn't a coincidence that the yield curve invert. It wasn't a coincidence that, for example, we saw a V shape because we saw from that point of time, the dollar was peaking. That's the key thing to look out for. Because when the dollar was peaking, it suggested that the funds was flowing out of the bond market. And why was funds flowing out of the bond market? Because they find that that particular asset could be less attractive. And if this is so, if bonds could be less attractive, then what would they put the money in? That's one thing for us to consider. And at the point of time, the intermarket saw the opportunity and they went into probably the stock market, leading to a V-shaped curve, V-shaped inversion in the stock market last October. All right. Now, the recent correlation of the dollar index and the S&P 500, we observe one thing. If you look at, let's say, the label that Mark 1, the observation is that the move in the dollar index is usually a few days or a few weeks ahead of the actual turn to the stock index. That means from the recent observation, what has been seen is if you measure into the turning point of the dollar index, that turning point usually happens few days to a few weeks earlier than the stock index turn. All right? Now, what I'm trying to suggest here is that if there could be another one more intermarket tool that you want to rely on, and that would be the dollar index to observe into the actual turn of the stock market. Because I presented this argument a lot to the institutional people last November and October. They were pretty much amazed by, hey, we can look at the stock market in this manner. All right. In fact, that was quite a hot topic last year in terms of presentation, and that worked out very well. In fact, if you take a look into right now, before the March 22nd of that rate hike, we saw that the dollar index was at the high, pretty much leading to that the stock market was bullish after a rate hike, even though after a 25 basis point rate hike. All right? Okay, now then, one more question. After knowing this, then what is the key points to take out from here? And this is very important because if you take a look at what I'm trying to present, number one is that we have a yield curve inversion. Right? People gave opinion because a lot of time when I was interviewed in the newspaper, they will ask me, what do you think, whether there's any recession coming or not? What do you think of going forward? I think that opinion is one thing, but the data cannot lie. The market last October, November already shown us they are pricing in a possible recession to come. The key question would be when, and that's the issue. If you take a look at what I've presented historically over the past 30, 35 years, the yield curve inversion usually precedes a rate cut by 1 to 2 years. That was the history that told us. Okay, first thing. Now, second thing is that what is more important is recently during the SBB, what we are seeing is a steepening of the yield curve. That's the most important thing to know right now. That means that that's the most important one piece of data that should be observed is the steepening of the yield curve. What is the steepening of the yield curve, right? It means that the long-term yield, all right, is actually rising. And the short-term yield is dropping. And they don't move in a gentle manner. They moved in a steep manner. That means the long-term yield is rising in a fast manner, and the short-term yield is falling in a fast manner, and that caused a huge steepening of the yield curve of what I've presented at the right-hand side. That means almost like a straight line up in terms of the yield curve, all right? The difference between the 10-year and the 2-year. Now, what does the steepening of the curve tells us? Steepening of the curve tells us that in terms of timing, it is a more accurate indicator of a rate cut. Okay, as long as you start to see that the yield curve between 10 and 2, it starts to steepen even more, then it is saying that very soon, as soon as 3 months, as soon as 6 months, we are going to have a rate cut. That's what history told us. Okay, and we are observing that in the recent event with SVB, with Credit Suisse, and last night, the yield curve, like 2-year yield, continue to drop below 4. It's right now about 3.7 plus. All right, the yield curve is again steepening at a fast rate. All right, observe into the yield curve, and then that will become a predictor of rate cut. Then, I know that we talk about a lot about Singapore banks today, right? But I wanted to say one thing. If you take a look about the environment here, where we have a possible high inflation, or not possible high inflation, but we have a high inflation, but a possible rate pause, because we are talking about it, and as what I'm presenting in the steepening yield curve, a possible rate cut. Then if you take a look at the environment, then I can only conclude right now this environment is going to be volatile. Why is it volatile then? Take a look at the case study of Singapore Bank. Now, if you have attended the session that I did, which to the right-hand side, this is a session which was done on February, all right? I think 16th of February on the live trading ideas on Singapore Bank. And I happened to do it with Jamie, all right? And we talk about going forward, what's up with the banks, okay? And my prediction or analysis at that point of time was that the banks, whether it's DBS, UOB, or OCBC, they are going to drop. In fact, we talk about how bearish I was with the banks, and I talk about how to hedge, all right, what to do if you want to hold on for the banks. Because at that point of time, when DBS announced the Q4 profit, right, it only also announced a special dividend. So if you want to hold on to the special dividends, then what to do? In line with a potential falling price at the point of time, the solution is to hedge, right? So later on, I think that Jamie would illustrate how you want to hedge. In fact, that day she called me and she said, "Hey, Binni, do you know how much others might have earned if they had attended your session?" Because if you take a look at the banks, all right, DBS dropped about 12% from the point I talked about it, and UOB dropped about 10.6% from the point I talk about it, all right? Now, what is more important is that I think that going forward is going to be a very volatile market. If you look at what DBS hinted during that reporting. DBS said, while underlying loan demand remained healthy, some corporates shifted their borrowing to cheaper financing options or repaid opportunistic borrowing, and wealth management customers reduced margin loans. What essentially DBS is saying is that the higher interest rate was hurting them. And if you look at another extract from Reuters, on the comments on the DBS earning, it said that based on the rate highlight, it said that the cycle peaks and the rising bank profit could be curbed. Now, going forward, what we have in terms of scenario would be a possible rate pause or a rate cut. If you take a look at the yield curve, unknown yet, but the yield curve are suggesting that. Second is that we know that traditionally high interest is going to benefit the banks. But with a possible rate cut, a possible recession, and might take a look at the current environment, which is with SVB, with Credit Suisse, a possible crisis coming in, I'm not sure, all right, then investing will be very tough. If you even look at what happens to the bank, despite a very positive earnings. My conclusion for today is that in order to maximize into the environment, then we have, and unfortunately, going forward, at least for the next half a year, we might have to consider short-term trading. That means the environment is going to be tough. Why? Number one, whether we're going to have a continuation in terms of rate hike, or we're going to have a pause, or we're going to have a rate cut, we are not sure. This is what is going to fuel the headline right now. That means the headline is going to come one moment, we might have a continuation in the rate hike, or next moment, we're going to have a rate cut. But what is most important is that if you take a look at the history with the yield curve inversion, that was followed by a period of recession. Recession is the keyword here. And between the actual recession to the yield curve inversion, what we saw from history was that there was a crisis. Okay. Now, it's too early to say whether there will be a crisis right now or not. Nobody can predict, even if you ask me whether there's a crisis or not, whatever that is, right, that came from my opinion. My guess, I would really say. Even if you ask analysts will tell you that that's my guess, whether they will or they will not be. I prefer to rely on the data, all right, and I prefer to look at not only the fundamental of the companies, the technical analysis, but also statistic from the intermarket, because right now the markets are very linked. Okay, we can't remove money markets, we can't remove the bond market from our analysis into the stock market, at least for the macro environment. Right. Then, if this is so, with these two underlying, I think that the trading conditions will be very, very volatile, and this is the reason why from the start of this year, I've been encouraging whoever who is to take my sessions or whenever I deliver a speech to adopt into short-term trading, at least going forward for the next half year. All right? That means that no longer we are in the environment of a trend following where you buy the trend and keep it there. I think that this year, it will be a very, very tough period where we will and we need to consider hedging. That means short-term trading, all right? Now, and lastly, not only to look into individual companies, I think we need to be looking at very much the interest rate environment, which is essentially what I've presented to you in terms of the yield curve. That means you can take a look at, for example, the 10-year and the 2-year to monitor that curve difference, the yield difference. And lastly, to look at the flow of money into the dollar. All right. With this, I pass my presentation to Jamie, where she will talk about more in terms of short-term trading and how we could hedge your position. Thank you.